Thank you for joining me for the Short Vol Show Live, this weekend edition. We're going to talk about the term structure, what's going on in the market, and more coming up next. Here's some Gregg.
Time and time again, I've felt these walls of plaster closing in. More than once I've felt that lonely feeling.
Alright, so welcome to the show. I know you want to watch Gregg forever, but we got to get to the market for a second here. So, we noticed the term structure come in a lot on Friday. That was good action for us to get back to normal. It's going to take a while to get back to normal. And what do I mean by normal? Well, a normal term structure would be an upwardly sloping curve for the VIX, which is about like kind of the opposite of what we have here. It would be upwardly sloping. So if I were to just get out my little pen and paper here, let's see if I can just do this real quickly. So let's take that, okay? And then a normally sloping curve would have spot kind of below and then the futures above it going up like this. So spot here, futures sloping up. This would be the front month, second month, 1, 2, 3 in my terrible penmanship with the mouse. This would be a normal term structure in contango, which is what we have in normal times. And it's really funny because for all of last year and the year before, when we were low volatility, slowly rallying market, we would say, okay, short UVXY or VXX, and people were coming up with all these like strategies, like you have your core short position, and then as it fluctuates, you short more, and blah blah blah. And we would always say at the end of the video, like, caveat, stuff could turn around, and when you are in that sort of situation, it takes a lot for for the downside edge to go away. You need a real spike, because if you get volatility to go up a little bit, well, all of a sudden you still have advantage to the downside for a while, even if you get a day spike or something. And then what you get is a situation where, like, okay, there's the spot, and you get like, all right, well, the futures are kind of flat, right? That's like the second part of like a few day spike. And then if you got weeks and weeks of spike, you get back to where we are right now, where you've got the futures way below spot and curving up towards spot, and we are in backwardation right here. It shows 9% backwardation. However, you'd think, oh, we're in worse shape than we were on Friday, because Friday, when I came on, I showed you at 7.3% backwardation. However, what you notice here is that the spread between spot and all the futures has greatly lessened. Well, not greatly lessened, but it has lessened by almost 2 points. We were looking at almost 5 points of spread between the front month and spot, and now we've got basically just 3 points. So things are normalizing quite quickly, which is it's just interesting. I just want you to kind of absorb this every day. If your main strategy has been the short vol trade, you might want to be on the sidelines right now. There's nothing wrong with being on the sidelines when things are nutty for a little while, but absorb what's happening to the term structure and watch it, because this is should be teaching you all kinds of different ways the term structure works. If there's some little known Steven Aniston videos on YouTube where he discusses different shapes of the term structure, and if you are a Steven Aniston client, you'll be familiar with them. These are different permutations of the term structure which happen when we are in extreme situations. And for like years at a time, we were just slowly rallying, and all we had was that contango structure, but we always warned, well, this is what can happen. Well, now it is happening. So absorb this, memorize it, and so that you can feel comfortable with it for in the future. And you can also feel that much more certainty when we are back in contango. This is all good stuff. I just wanted to talk for a second about, you know, working for a trading firm in Chicago for many years. I was basically living the world of options for like 10 years. Like, we'd go up to the office after work and all we would talk about is options. I had to compete with, guys from Yale, Stanford, to get into the trading program. And, it was all options all the time. And, it's like the alpha male thing where we're competing and everybody's smarter than everybody else. And there we were given a very solid foundation in the options world. And unfortunately, coming into this, and you can be the most motivated person, and you can come in and watch all the YouTube videos, take training classes from maybe Option Alpha or Tasty Trade or what have you, and absorb all this information. You can read books, but you're not going to get the totally rounded options education that you would in a trading firm, where they're going to, basically like put your feet to the fire and grill you until they feel comfortable with giving you their money to trade. I was very lucky to have that education, but people who learn options sort of online and piecemeal, sometimes they miss important concepts. And you can get away with missing some important concepts and still make money trading options for long periods of time. But I find myself filling in these concepts for people at times, and had an example of that a couple weeks ago. And this is a hole in a lot of people's understanding that I just want to talk about right now, and it is the difference between selling a call spread and buying a put spread that's at the money. Okay, so let's take a look. We'll just use Apple for example here. Okay, Apple's trading 156 right now. And we could even go out a couple months. Let's go to March, okay? And this is not switching over to their Apple, so I have to fix this. There we go. All right, so now it should be linked. Apple. All right, so if we go out to March at the money, okay, it can seem like, okay, well, selling a call spread versus buying a put spread, it can seem like, okay, you're selling something in March, that's got to be a short Vega trade. You've got to be selling volatility because you're selling something, right? Whereas, you're buying something, you have to pay for it. That's got to be getting long volatility, and there's got to be more decay associated with buying something, right? And it really comes down to which strike you're staying close. If you're buying a spread, the Vega concept is largely going to be canceled out. And as far as theta or daily time decay, it really depends on which strike you're staying next to for the longest and which strike you're staying next to closest to expiration. Whether it's going to be a positive or negative theta or decay trade. But that being said, buying a put spread, and this is, there are some caveats to this, and there are some technicalities that you can say, Dave, it's not really the same because I can exercise these calls to collect a dividend in a special dividend situation or a two-tier takeover, this or that. Okay, geniuses, that's fine. If you want to get really technical, you can, but in broad strokes, buying a put spread and selling a call spread are the exact same thing, and they're essentially Vega neutral. Because you're buying one option and you're selling another, so that kind of cancels out the Vega of it. And if they're straddling the at the money, like for example, Apple 156, if you're buying the 50-60, the 150-160 call spread, or you're selling the 150-160 call vertical. It doesn't matter either, buying or selling. You're not worried about Vega in this trade. It's a directional play, and you're either saying that this is going to be above 150. It's going to be either between 150 and 160, below 150, or above 160 at expiration. And this is usually kind of like a safe, limited risk directional play. So if I'm buying if we're taking the 150, 160 vertical, okay, that is a a $10. There's $10 between the strikes. So if I sell this call vertical for, let's see what it is on the screen here. So if I sell the 150 and I buy the 160, okay. If I sell the 150, 160 vertical for $5, that is exactly the same thing as buying the put vertical for $5 because you're subtracting the premium from the strike and seeing what's left over. For a better example, if I was selling this call vertical for $4, it would be like buying the put vertical for $6 because you're subtracting the premium from the strikes and seeing what's left over. And also, the amount of capital that your brokerage requires you to put up is going to be the same. You might think, oh, well, I'm selling it, I'm collecting more capital, it should be, I should have less capital requirements. But no, it's the same because if you're selling the spread, you're going to have to cover for the risk between whatever you sold it for and what it could be worth at a maximum. If you're buying the spread, you're going to have to pay the premium for it. And those two are going to be exactly the same. It's going to have the same capital requirements whether you sell the call spread or buy the put spread. So I was posing a question online, and I get this question all the time. So if you miss this one, don't feel bad about it because it trips up a lot of retail people, and it's just because as a professional, if you're in a training program, they're going to force you to do your synthetics over and over again, especially if you're trading indices because you're going to be doing the math in your head if you're standing in an index. You're going to be doing the boxes in your head. So buying a combo in one strike and selling a combo in the other, you're going to be pricing stuff back and forth in your head to see what's comparatively what's better. So if you have the 150, 160 call vertical, selling it, which would you rather do? Sell the call spread for sell the call spread for $4 or buy the put spread for $5. All things being equal, you would rather buy the put spread for $5 because if you buy the put spread for $5, that is synthetically selling the call spread for $5. Selling the call spread for $5 is better than selling the call spread for $4. And the selling the call spread is identical to buying the put spread. So if you're selling the call spread and a $10 between strikes, if you're selling the call spread for $3, that's identical to buying the put spread on the other side for $7. It will work identically for your capital requirements, and it will work identically as your risk profile is concerned. So when you're looking at it on the screen, you just want to figure out which is the better deal, which is more liquid. If you see that there's a lot more liquidity on the call strikes, then that's probably a better one to trade mid-market because there'll be more liquidity there. And that's really it. If you've got something that's like way away from the strike, then you might start it starts to become more real volatility. For example, if you've got like if you've got SPX and you're looking at the if you've got the SPX and you're looking at like the 2,190 put vertical, that starts to look more just like selling in, like, let's say out in September, if you were selling the let's see, 1,800, 1,750 put vertical, that actually is selling some real Vega. You're away from the strike. Selling the put vertical is similar to just selling a put that's out of the money, and it's going to act like you're selling an out of the money put. Same thing with if you're buying a call vertical that's way out of the money. You know, you're buying in September, you're buying the 3,100, 3,200 call vertical. That is going to act, since it's out of the money. It's not like the two strikes are straddling at the money. Since it's out of the money, it's going to act just like you're buying an out of the money call. And we know when we're buying an out of the money call that those are soft deltas. You don't want to, if it says, okay, I'm buying it out of the money call, the delta is a 5 delta. If you sell the underlying at a 5 delta versus those calls, you're going to get crushed if it slowly moves to the upside. Way out of the money calls, just like way out of the money puts, are soft deltas, and you don't want to hedge them with the actual underlying, because if it walks up to that price, any of the actual underlying you sold, you're going to get hurt on real deltas, whereas the gain that you think you're getting from the calls is not going to happen. So way out of the money calls or way out of the money puts, it's going to be different. There is going to be a Vega component to them. But when you're talking about at the money or even pretty close to the at the money, there is really no difference between a selling a call spread and buying a put spread, and there's no Vega to be considered. It's just because the two options really cancel themselves out, and you really have to think of it as the options are canceling themselves out when you're doing these verticals, and just consider them a directional play, and as opposed to thinking of them in terms of volatility. If you buy a call and sell the underlying against it far out, you are locking in a certain volatility level. As soon as you hedge it with the underlying, you're locking in a certain volatility level, and you can look at the trade that way. But if you were just trading a vertical, I would look at it in terms of ratio. So if I buy the 50-60 call vertical for 250, I'm betting 1 to get 4. And I would look at it in terms of the ratio of what I'm paying for what I'm receiving. If I'm selling it, okay, well, I'm risking 750 to make 250. I would think of it in terms of a ratio, whereas if I'm just buying a call or selling a put and hedging it with the underlying, I would think of that as locking in a certain volatility level. And we know that, if time passes, those things are going to decay, and it is actually going to represent a different volatility. But the other caveat with that is, if you look on the screen and you see a call and it says this is this volatility, if you just buy the calls to get long and hang out, if you're not trading anything against those calls, you're not locking in any volatility. You're just buying a call, and you haven't established that you've locked in a certain volatility level until you actually hedge the option. Anyway, that's just a little lesson in options theory. Like I said, it's perfectly understandable that people, and I'm sure it happens all the time, that retail people can come into this business, learn some options theory, make great money trading options, but they do have these little holes in their knowledge here and there just because they haven't been schooled and they haven't been sort of classically trained in this stuff. I'm not somebody who's going to come in and say, claim that I'm like smarter than anybody else or that I know so much more than other people. There's only a very small, little teeny part of finance that I know really well. And there's tons of experts in all kinds of other parts of finance, but this very small part of finance I know really well, which is options, volatility, and pricing. And when you come on YouTube, the great thing about YouTube is anyone can come on and talk, but the bad thing about YouTube is that anybody can come on and talk, and so you don't really know who you're talking to when you, for example, are learning about options or trading stuff. It could be somebody who just read a pamphlet yesterday, and so there can be little holes in your knowledge. There's a lot of people who are very, very popular on YouTube, even in finance, that don't really have any great knowledge, but it's entertaining to watch them. And you want to make sure that you're getting your information from a reputable source, and I would definitely do that. I would consider, for options theory, getting the books, although they're a little dry, the Macmillan books, the Macmillan book, Options as a Strategic Investment, and the Shelley Natenberg books. They're just going to give you the basics, and you want to learn your synthetics, definitely. Buying a call, selling the stock is the same thing as buying a put. Buying a call and selling a put is the same thing as buying the underlying. Selling a call and buying a put in the same strike is the same thing as selling the underlying. And you should be able to think in your head what does the chart of being long a call look like? And you can certainly model them in whatever software you have. For example, I can model here in Thinkorswim what it looks like to buy out of the money calls, for example. So I could model in here what it looks like to be long some out of the money calls. So I could buy these Jan 2700 calls, and then I could model what my chart looks like. A long call chart is going to look like on expiration. It's going to look like you make nothing till you get to the strike, and then once you get to the strike, those calls are going to act like stock on expiration, and so it's going to be the chart is going to be flat until you get to the strike, and then it's going to slope upward just like the stock, each call representing 100 shares of stock when you get to expiration. And if I get out of the way, of course, this is going to show, that blue line is going to show how these calls are going to act on expiration. On expiration, it's going to act like you're long 100 shares of the SPX, and this is the chart of the way the calls are going to react ahead of them expiring. They're going to take on more and more of a delta as you get closer to the strike and farther away to them being in the money. And you should be able to generally know what the slope of your risk curve looks like for your position, and if you don't, you pull it up. But you should know, you should have an understanding in your mind. You should be able to close your eyes, and I'm not a big technical analysis guy, but I can definitely close my eyes and imagine what the chart looks like for any underlying I'm trading. Tilray, for example. I'm not a technical analysis guy at all, but I know back and forth what the Tilray stock chart looks like. I know what my risk profile looks like, and I know how much approximately I'm going to make or lose for a 20% move or 30% move. And these are just basics that you should be knowing before you jump into this stuff. If you're taking a little break and you've got really small positions now because the market's all haywire, take this time to build up some more options knowledge. Take this time to study up a little bit and get your chops back up on options theory and how this stuff works. It will serve you well in the future if you do that. All right, so thanks for watching. I'm going to put Gregg back on, and hopefully they don't ding me on. Hopefully they don't ding me on monetizing this video because I had Gregg Allman on. I don't want that to happen. So I guess I'm just going to leave it here without putting Gregg on because I don't want to get dinged. All right, thanks for watching, folks, and be careful going into next week. Nobody really knows what's going to happen. It seems like the market's calming down. I think we've seen the top of volatility for now. But, if we get another big down move, this thing can turn back into moving away from normalizing just as quickly as it started normalizing last week. So definitely be careful, be small, and stay. You always want to stay in the game to trade another day. That's the key. All right, thanks for watching, and we'll see you in the next one.